the performance figures from the study show that in the long term, equities outperform the other asset classes, which is really what you would expect, because if shares, equities, didn't outperform the asset classes, then bearing in mind they go up and down an awful lot more than gilts or cash, if you didn't get the outperformance, no one would ever invest in them. But over the very long term, what they show is that equities give a real return, adjusted for inflation, of just under 5% per annum, and gilts give a real return of just over 1% per annum, whilst cash gives a real return, adjusted for inflation, of just under 1% per annum. And what the statistics also show is that equities are significantly more volatile in the short term. So you get an immense amount of wobble on equity prices, which we all instinctively know. Any investor that's ever invested in shares understands that their prices go up and down. And we measure that with standard deviation and or what we call volatility. And the volatility of shares is much higher than gilts. But if you look at the real returns, then once you get past a holding period of around 11 years, the real returns from equities are less volatile than the real returns from gilts. And that's because the effect that inflation has on the purchasing power of gilts versus equities.